The NVIDIA stock has been the topic of many conversations lately, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, I would recommend to be mindful about which stocks to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. NVIDIA has had a very volatile period recently, and by recently I mean over the past 2 years, as the stock rose significantly and then fell by almost as much as of June 2022, because there was a huge capital flight in and out of the semiconductor and the microchip sector, as one of the more extreme examples of the recent times. One thing that really sets NVIDIA apart from many of the tech stocks we've covered before is that NVIDIA is a well-established company from both a brand and fundamental perspective. The market does expect NVIDIA to come up with new disruptive technologies and to explore new sectors of activity, but it also expects NVIDIA to deliver solid financial results. In other words, both of those elements are required in order for NVIDIA stock to rise. Another factor to consider is the sector's outlook as a whole, including the competition around NVIDIA. I believe that this dynamic should be looked at like the EV sector, in the sense that different companies will be each other's commercial rivals, sure, but at the same time, each company's stock price will be the other company's financial support, or like a proof that this sector as a whole is worth that amount. This sounds contradictory, and frankly, it is to a point. But ultimately, people look at the semiconductor and microchips sector as a whole, and sometimes they will pick specific companies to invest in, but for most of them, they may simply pick an ETF, including NVIDIA and many of its main rivals, the same investment. So, looking at the big picture, I feel like the entry point for the short term might be now. But in the long term, we should also be ready for larger corrections because the stock has risen more than Nasdaq over the past 2 years, and I do believe that we should expect more corrections as a preventive measure. Now, let's also take a look at the technicals of NVIDIA. The trading volume of NVIDIA has recently been 34 million shares versus an average volume of 51 million shares. Over the previous 52-week period, the price fluctuated between $140.55 and $346.47. Trading volume is a metric that can tell you how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the stock, and when we use it to compare it with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal could happen soon. The market cap of NVIDIA is currently around $394 billion versus an enterprise value of $462 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost the company has already paid for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies might be the intangibles, which means that they're not items or stocks that a company can use to generate income, but promises that the company can grow in the future, such as intellectual properties and branding. For tech and startup companies, most of their valuations are based in the intangibles, meaning if they've been valued in more favorable market conditions, this means that there could be a huge difference between the market cap and the enterprise value, and also giving us a false impression that the company is trading at a discount. It's trading below the book value, but it doesn't mean that the company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place and that it's been deflating back to somewhere more normal. As we compare the current price to the historical price fluctuations, the stock is 141% higher than the 1-month low, 141% higher than the 3-month low, and 141% higher than the 52-week low. On the options market, which gives us a hint about what the market sentiment is, the implied volatility is 53% versus a historical volatility of 63%. The put-call volume ratio is currently around 0.71. It is normal for most stocks to have a higher put option volume than what they deserve because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 393,000 contracts a day versus the 30-day average volume of 451,000. In terms of open interest, the most recent volume of open interest has been 2.7 million contracts versus the 30-day average of 2.6 million contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving you the right and selling the contract giving you the premiums with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there may be possible uptrend on the move, or that a reversal could happen if there's a lot of call options. The reasoning behind that theory is quite simple, as most options are traded by people hoping to catch up a train that may have already been gone, and most of the option contracts usually expire worthless. In terms of its shareholder structure, institutional shareholders own 70% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Invesco. It is relevant to understand the shareholder composition of a company, as this can help us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, it could be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a good investment potential, and not just a short-term trade. Obviously, this applies for NVIDIA. Frankly, there's a lot of exceptions to what I said regarding the 25 to 30% because many great companies could be held for the most part by retail, but that tends to be the exception and not the rule. Very often, if they're mostly held by retail, it means that they could be very speculative in nature. Now, let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes, when there is significant short interest in the total volume, this could be a sign that there's an organized shorting operation occurring, such as what happened with GameStop and AMC. The current short volume is 1.3% of the total float, and 62% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume, and a significant chunk of it coming out of the dark pools, this could suggest that there are institutional positions taken to short the stock, and that there would be potential for a short squeeze. Given all this, my recommendation is to buy a small position now, and to save at least half of your allocation for later, which could be gradually bought over the next 12 months. I would recommend to commit between 5 to 8% of your portfolio. And I would also recommend to split the allocation in batches of 20% at a time so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.